You're buying a home and you have $10,000. Are you better off putting it towards your down payment or paying off debt? Most people guess down payment, but the math may say something different. So let me walk through how that works to make sure that you're using your money in the smartest way possible. I'm Rebecca Richardson, aka the Mortgage Mentor, and here on my channel, I talk about all things real estate and mortgage and giving you the tools and the information so you feel confident about the choices that you're making and can make smart real estate choices. So be sure to subscribe and, as always, comment with any questions. When it comes to the best way to use your money when buying a home, a lot of buyers get tripped up on what they should do as far as what is the right amount of down payment. Now, there are minimum down payments depending on the loan type, but anything over and above that, what is the smartest way to use your money? And a lot of times buyers think about the mortgage in isolation. They're not necessarily thinking about how that factors into their larger budget, their larger financial plan, and how they can get the biggest bang for their buck, especially in this market. So most of the time when people are looking at a chunk of money and they're thinking, do I put this towards my down payment? Do I set it aside? Whatever it may be. Again, thinking that that's going to give you a lot more leverage. But what they're not typically thinking about is how consumer debt sits on the other side, of that question or of that equation. The important thing to know is that every dollar of consumer debt that you carry, it does impact your qualification. So from the standpoint of, we're not necessarily concerned about what you owe, but it does matter what you pay. So what does that monthly payment actually do to what you can qualify for? Every dollar that is going towards monthly debt reduces what can go to your housing payment. And that's essentially how a debt to income ratio works. How much debt do you have, including the mortgage payment, compared to your gross income? And based off of, again, the loan type that you have, there are different debt to income thresholds, but that is going to limit what you qualify for. Let's say you have a monthly income of $6,000 and you have $200 a month in credit card debt or credit card payments. That means that right off the top, that's $200 that can't go to the mortgage payment, that can't go to qualifying for that loan amount because it's allocated elsewhere. So what happens though is if you're able to pay off that debt to eliminate that monthly payment, that means you can qualify for a lot more. So let's kind of walk through what that math looks like. And I'll say that the buyers that understand this early are the ones that are able to have a really good strategy into how they're buying a home and making sure that they're using their money in the best way possible, in the smartest way possible to give them, the best cash flow and the biggest bang for their buck, literally. Here's a recent example from a client that I was talking with. So they had an extra $10,000 and they were trying to decide, do we put that towards the down payment or what do we do with it? So they had enough money for the down payment and the closing costs. This was truly just like, we had extra money because they wound up buying less than what they expected. What should we do with this money? So they had a credit card balance, or they had a couple credit cards with a balance of around $10,000. And that worked out to around $200 a month. So what we can do is, instead of putting that $10,000 towards the down payment, what they decided to do was to put that towards that credit card debt to help their monthly cash flow feel a lot better. Or just, they're going from a rental, going into a new home, yes, they can afford the mortgage payment, but it's a step up. And so they wanted a little bit more breathing room in their budget. Now, from the standpoint of, contrast that to if we put it towards the house and using a 6.5% rate, here's where all the disclaimers come in, that this is an illustrative rate, these are not current rates, this is not a commitment to lend, but this is enough so we can go through the math. So at a $350,000 loan amount and a 6.5% interest rate, that $10,000 going to their mortgage would only drop their mortgage payment by about $50. But again, if they paid off the cards, they were able to save $200 a month. So there's almost $150 difference for the same amount of money out of pocket. And if this comes down to a situation where maybe it's not so much of a want to, right? It's a, how do I qualify for more? Do I put more towards the down payment or do I pay off debt? You're going to be able to qualify for a higher loan amount if you lower the monthly consumer debt necessarily than putting it towards the house. So each situation is different. And that's why when I'm going through the scenarios with clients, we're talking about, what does this budget feel like for you? How much money do we have to play with here? Because again, putting all of it towards a down payment typically doesn't get you as much as it feels like it should, right? $10,000 is a lot of money. $50 a month doesn't, impact your cash flow the way that $200 a month savings will. And that's why I would say is that the goal isn't always to put down as much as possible. It's to put your dollars where they're going to have the biggest impact. And I'm not saying that you should go and pay off everything before you apply for a house or not, but it's more from the standpoint of, that's the benefit of talking with a loan officer like me early in the process because we're able to look at the full picture and again, find out the smartest way to use your money that is going to feel like a win across the board. Not just from what you're able to buy, but how your monthly budget is actually working and how you're balancing your assets, the money that you have available for the down payment and money that's in the bank, and then any of the debts that you currently have. So it's not a universal rule. There are situations where putting more down does make sense, but that's where the personal aspect of doing a pre-approval early enough in the process so you know how your numbers work and you understand what your options are, and you're able to make these decisions without necessarily being under the stress of, oh my gosh, I have to rush this decision so I can get a pre-approval so I can get this home under contract, right? Let's talk about how the money works before falling in love with a house. Which is why if you're sitting on savings and you're trying to figure out what to do with your money, having an early conversation really will benefit you in the long run. If you're trying to figure out which strategy makes sense for your situation, it's a pretty easy conversation to have. The math is usually the easy part, and then that way you know what you're working with. If you have any questions, I'd love for you to drop them in the comments. Be sure to subscribe for more information like this, and I'll see you next time.